Hello everyone. Welcome to our discussion of Chapter 2, again using PowerPoint slides to guide us through the important parts of Chapter 2. We're revisiting the income tax formula we learned in Chapter 1 and how it relates to the 1040, just adding a little bit of extra information, complexity to it so that we can apply it to a little more real life situations than we did in Chapter 1. So we're going to take a look at the 1040, the schedules, what goes on those, and the concept of adjusted gross income. And the reason why we're going to have this calculation of adjusted gross income, this includes some deductions, okay, some permitted deductions, but not all of them. And so just to give you kind of a heads up, when tax people, tax professionals refer to what's called above the line deductions, those are deductions that reduce adjusted gross income. And when they say below the line, those are deductions that come out after you've calculated adjusted gross income. And the reason why we differentiate is because many deductions and credits are based on AGI. For instance, child tax credit, okay, phases out when the taxpayer's AGI gets over a certain threshold. So the more over that limit you are, the less of the credit you get. So if you have a deduction that reduces your AGI, it not only reduces your AGI, which then is part of your calculation of taxable income, but it also is going to increase the amount of your credit. So it's a extra, you might say, important or beneficial deduction. And that's why we separate those in our calculations. Not everything matters whether it's above or below the line, but most things do. Okay, so this is our expanded tax formula. Remember, we had gross income minus permitted deductions in Chapter 1. Now we've split that into two, and we've put a subtotal in here, and that certain deductions are above the line, in this case literally above the line permitted deductions from gross income. Then you calculate adjusted gross income, and that's listed on the 1040 on its own line, specific line, and then you subtract the standard deduction. Remember, so far the only one we've learned about, and we won't really learn what these permitted deductions from gross income are until Chapters 3 and 4, but so right now we still have the standard deduction, but notice it is separate, okay, or itemized deduction. We'll learn about those in Chapter 5, but we subtract the standard deduction, our only permitted deduction. Okay, there was no splitting of that in Chapter 1. Now we split them, still get to taxable income. So any deduction, either these kind or these kind, reduce taxable income. So you subtract it to get taxable income. But this kind reduces taxable income and reduces adjusted gross income that may impact how much your tax credits are. It may impact even other deductions that are part of this group. Okay, so that's why we want deductions. The most beneficial ones are those permitted from gross income versus, from gross income to get adjusted gross income. So they're used to calculate adjusted gross income or take it out above the line. Okay, they're better than these ones here. Okay, again, multiply the tax rates, tax liability. We separated before. We just basically had credits, payments, and then such all down here. Now we've kind of separated them out. Tax credits, which again we won't really delve into until Chapter 9. Other taxes, we'll introduce a couple of those early on, and those will kind of filter in different chapters. And then your tax payments and refundable credits equals your tax refund or tax due. Same result as it was in chapter 1. We haven't added anything really new except for separating things and adding some subtotals. All right. In chapter 1 also, we only mentioned that really dealt with single or married filing statuses, but we noticed when we used the tax tables and some other references that there's really, and there's even a homework problem in chapter 1, there are 5 filing statuses, really only 4, as we'll get into in a minute here, but 5 that we'll talk about. First one is single, and basically all of the statuses are determined as of the last day of the year. So someone to be filed single, they must not be married as of the last day of the year. So for 2024, last day, 12/31/2024, that's what your status is determined. Okay? If you're married on that day, you cannot file single, and if you are single on that day, you can't file married. Okay? So it must be legally married on the last day of the year. Okay, that status is determined by the state that they live in. Okay, it doesn't matter who earns the income. If they both have income, one has income, or anything in terms of that. Married filing jointly, you file together as one person. Okay, it doesn't matter who has the income. That's the difference with married filing jointly. So a single person files a tax return, married filing jointly files a tax return for 2 people, right? So you might say that it's more efficient to the IRS to get 2 people covered on one tax return, married filing jointly, and you might say that that's why they've written in some things into the tax law that make it more advantageous to be, if you are married, to file jointly and just one tax return. So the third one is, and we hadn't even considered this idea in chapter 1, now we do, married filing separately. Again, you have to be married on December 31st, but you can elect to file separately. So to file jointly is a choice. Married or single is a legal status. You can't choose whether you're married. I mean, I guess you do choose, but you, based on what you are, what your legal status is, married or single, that's what you are. You can't choose, say, oh, I'm married, but I'm going to choose to be single. That's not how it works. But you can choose to file separately. Now, both spouses need to kind of agree on this, okay? But typically there are some limits to this. And you remember we said that this is kind of more of a pain to the IRS because now you're getting 2 tax returns for 2 people that they have to take care of and match up and everything. So there's some kind of gotchas in this married filing separately. Standard deduction, okay, can only be used if they both can't have one itemized, one's do the standard, and we'll learn more about that in chapter 5. You got to show the social security number of the other spouse. Okay, so husband has to have the social security number of his wife, vice versa on their. So it's no way to disappear as to file separately. And it's only in some very unusual situations is this a better deal to file separately. Typically, if you're going to advise a client to file separately, it is typically when one spouse makes a lot more money than the other. There's some very limited situation where that might be beneficial. Second, because if you're married filing jointly, both spouses are on the hook for the entire amount of tax owed for the couple. So if one of them is a deadbeat, the other one can be held liable. The IRS is going to come after whoever they think will pay them. Okay, they don't care which spouse they get the money out of, as long as they get it out of somebody. If you file separately, then the IRS can only come after your separate tax liability versus the amount for your spouse as well. Okay, so there's a situation of jointly, and if you're filed separately, it might be advantageous. It might cost you some more money tax-wise than if you'd filed jointly. It's the total tax between the two of you, but it may allow you to avoid a liability for a spouse that maybe you feel is not being entirely truthful about their income or some other things like that. And there's a concern that they might be held liable for that amount, the taxes they're not paying at some point. All right, head of household is probably the most technical, meaning you got to have the most going on to make it work or to qualify. First of all, you're single at the end of the tax year. Okay, that's the status. You're single on 12/31/2024. Now, they did add into this that you could be a head of household even if you were technically married, but your spouse had disappeared on you, so you couldn't divorce them, and they were gone for the last 6 months of the year. That was originally referred to as the abandoned spouse rule, because one of the spouses takes off, the other one can't find them to divorce them or anything like that. And yet here you are at the end of the year living like you're, having to be in charge of the whole household, having no help in that regard from the other spouse, but technically being married. And so you're kind of like, well, before this status, you had to file separately because you didn't know where they were, so you can't file jointly. But this allows you that if they're gone for 6 months, you can qualify as unmarried and therefore be head of household. Because if you're married and you're living with your spouse, you cannot be head of household. Okay? You see also U.S. resident, but it's not just enough to be unmarried. You also have to maintain a household for a qualifying person, a dependent, for more than half of the year. And we'll get into what a dependent is a little bit later. But that's one of the reasons why when we learn about dependents, it's so important, okay? Because you have to have a dependent and you have to have maintained a household to be head of household. You can't just be single. Okay, you're not the head of household if you're single. I mean, yes, you are in a sense, but you aren't for tax purposes because you need to maintain a household for a dependent. With more and more parents being cared for by their children in their elderly years, they wrote in an exception that parents can live in a separate household. So I could maintain a household for my mom. I'm single, maintaining a household, and she lives in a nursing home. That could be, and I say, make sure that all that happens, maintain that household, then I could be head of household, even though she's in a separate household. Okay? Other dependents got to live in my household. Okay? Same four walls for more than half the year in order for me to qualify as head of household. Okay? So there's a lot of things going on to determine head of household. All right? It's a better situation tax-wise than just being single. So you can see why they put all these extra rules. If you're going to get a benefit in the tax law, there's probably some hurdles you got to jump over, some hoops to jump through to get that. And that's what you see on your slide right there. Okay? Now, the last status, as I mentioned in chapter 1 when we talked about it a little bit, is, and I went over in the homework, is not really a separate status. This is a person who would not normally, under the the rules we've just seen qualify to be able to file married filing jointly. And we make an exception and allow them to file married filing jointly. So it's qualifying widow or widower. Notice the next phrase, with dependent child. Not just a dependent, but a dependent child. Okay? So you can only get that for 2 years after they die. Okay, so you lost your spouse in 2023. You can file, if you qualify, as a qualifying widower for 2024 and 2025. Okay, but you must have been eligible to file a joint return the year of the spouse died. Okay, and the year that they die, you file jointly. Okay, death during the year does not change the status. So if I lose my spouse in 2024, anytime up to the 31st, I still file as if they were still alive in terms of status is concerned for 2024. Okay. So, but in 2025, okay, then I would be unmarried, right, in 2025 because my spouse has passed away. So I'm no longer married legally. All right. I would be single unless I qualify with the next one, okay, for 2025. 2024 is clear cut. But 2025, I must pay for more than half the cost of a household as a principal place resident of the tax me and a qualifying child, dependent child. Okay, and that child needs to be under 13. Okay, so it's not just any child, because we'll see later that a child is typically could be up to 19, but not for this particular situation. Okay, this must be a dependent and it has to qualify for the dependent later on. Okay, we talk about dependents for the entire year. Okay, so not just half the year. It's got to be a full 4 year. There is temporary absence can be admitted away for school or things like that. Okay, on vacations, that sort of thing. All right, so this is a special status for someone who's lost their spouse but still has young children living with them at home that they're providing all support for. And they can't have gotten remarried. Now, of course, if they got remarried, they can file jointly with their new spouse, so it wouldn't matter. That wouldn't be an issue.